one of the constant conversations is loan to value, period. Right? How cushioned are we as the lender from the market? How much of a margin is there for, different economic outcomes of different things that are unforeseen? We target a pretty low loan to value. We're targeting around that 50 to 55% LTV. And the reason for that is, again, the market's up 47% in the last handful of years for single family homes. So we don't need to be overly aggressive, one. And then two, on the flip side of that is that it gives us a huge cushion with borrowers that have a past of having, bumps in the road. Now, again, our on-time payment percentage is in the 96-ish percent range. So we don't have a lot of missed payments once they're on track. But worst case scenario, we have to move to foreclosure. We're picking up, 40, 50% equity on that side.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Nick Deangelo. Nick Deangelo is known as the fixed income GOAT in real estate circles with a $206 million plus portfolio. And in just a minute, we're going to speak with Nick Deangelo about fixed income. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Nick Deangelo. Welcome to CREPN Radio.
Darren, great to be here. Great catching up with you beforehand, and I'm excited to dive in today.
Well, I'm delighted you're here and looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I got my background at one of the most critical points in the real estate market history, the global financial crisis. That's really when things took off. And I was confident I wanted to go into real estate. So I went full speed ahead. I worked for free for two different small family offices, multi-generational, 3+ generations. And I worked 100% on performance. And I was very comfortable with that. It got me in the door, and it actually sat me next to the patriarch of both companies. So next to the CEO, and what I learned above all else, something that I think about every single day when we make decisions at Saint, is multi-generational long-term thinking. When you're thinking through portfolio management, asset management, etc., I constantly saw that they had the ability to weather storms by long-term thinking. I constantly saw that they weren't overly conservative. They actually were building into their acquisition models, their asset management models, their partnership models, etc., degrees that would allow them to weather different storms and to pass different critical points in the business. So as things evolved, I started in the acquisitions piece. We were buying up to $10 million a week of different distressed assets. Very proud of the results there, but we woke up in a unique position where we had bought so much that I was kind of getting my arm twisted, just saying, hey, Nick, look, the game plan here. You wrote the 50, 75-page reports on each acquisition here. Why don't you just execute the game plan on the asset management side? So started in acquisitions, bolted on the asset management piece and built out a team there. And then eventually in 2015 or so, we started working with additional investors, retail investors, and opened up that institutional style model to the retail investor world. So now fast forward to today, we focus on fixed income using that same mentality of a long-term approach, 10 plus years, 20 years of, looking ahead into the future at what investments will be solid, looking, long-term into the future. And so today we focused on fixed income with that approach with a large target on single family mortgages. So that's a little bit of soup to nuts in a condensed format.
Got it. Well, your real estate experience there is I mean, pretty rich. I mean, from the standpoint of being able to be working with the family office, doing acquisitions, asset management. I mean, those are you buy right. That's a good starting point. And if you manage it and can make it profitable. Were those assets that were being purchased in those portfolios, were they for long-term hold, or were they for a more like a value add kind of a sale, or what was the
Great
plan?
question. The answer is yes, right? It's a little bit of both, but the truth is that that was a point in the market. Every market has different opportunities, and that was a market with huge opportunities for discounts, but didn't have a lot of huge opportunities to raise capital or find capital, or, there wasn't a lot of money floating around. Most banks were clutching things very closely. They were dealing with foreclosure crises. And on our side, we took, an opportunity to do that. But these purchases all were with the idea that we'd have no issues holding them for over 10 years. Right. So that was the first layer of underwriting and diligence. The second layer of underwriting and diligence is how much of a basis discount are we getting? So, hey, if we didn't like the operations on this, or we didn't like the outcome of, the leasing market or other things that we found out later on down the road, over 5 years or whatever, then we had no problem also breaking up with that asset and moving on with our lives because our basis was so competitive. So it was a little bit of both, but the first layer of underwriting was always, what would this look like as a 10-year hold? And if we weren't really interested in over that period of time, we passed pretty quickly.
I like that kind of approach. I feel like a lot of the more recent investors have viewed have viewed real estate in my eyes, maybe not the way I do it, but or the way I consider real estate, but more in like a stock, almost like a buy, sell. And I think one of the things that gets lost in that viewpoint is just the transaction cost. It may be one thing, from your phone to buy or sell a stock, but selling a real estate, a piece of real estate for a discount, you can sell it pretty quickly. But if you're trying to maximize your profit, it could take some time, and there's some costs involved and all that. And so I'm always I'm happy to hear there was some sort of a more of a long-term view of things as opposed to some of the shorter term kind of things. So tell me, your experience on with working with the funds and that. Did you are you still affiliated with those family offices, or is that something that you broke off and are now doing on your own?
So Saint Investment Group is completely unaffiliated from any family offices, et cetera. We're a standalone group. We're a standalone investment group. That said, I have great relationships with the family offices still. We've done a lot of deals together. The only difference and the only thing that changed, just like generations change over in families, is the interest in being on the acquisitions cutting edge of everything, right? So the patriarch gets older, younger generation has some, needs a lot of, a handful of years to learn, et cetera. There was a handoff going on really at both family offices, and it was very much a niche family operation at both, with, huge portfolio of different holding stocks, private equity, real estate, et cetera. And at the same time, Saint was blowing up. We had done a lot of things. We had a lot of experience, and we knew that there's a good time in the market. And something that was key that we saw was the market fundamentals were shifting dramatically. Think about 2015, right? We had from 2008 to probably 14, we were all sitting there with that looming double dip recession for those of that want to wind back the the economic clock of what the doomsday prediction was at that time. And on our side, we just weren't seeing it. We just weren't seeing it. So I was in the market. I was actively in the distressed market space, seeing that dry up, seeing that change and evolve different directions. And the last key thing that happened is we were sitting in a deal and we were 3, 4 years into a deal, and we bought this for, I don't know, 50 cents on the dollar in the height of the global financial crisis. So crazy numbers at a very unique environment in the market. It was a mixed retail, mixed office, right across from a key government building with tons of flow back and forth between all kinds of people. What we saw was that the markets were shifting more than we had expected in different areas. So what it required was this Olympian level, lift on leasing. And we just saw, hey, look, we are missing something on the baseline, deeper and larger scale economics. We are looking at the standard diligence items; those checked the boxes, but something is off here because now that we see the clock move forward, we could have checked some of these out in the future. So we overhauled a huge amount of our acquisitions, and so you'll see me talk about economics quite a bit because the focal point from that point was to understand the bigger economic trends that went into things. And in order to do that, we couldn't be locked in the hip with any particular group. We needed to be able to make our own decisions of what the economy was showing us, what the future was showing us, and then kind of where it took us from there was I had access to tons of off-market, distressed assets, working with banks, often up to 10 million a week. What we found was that they were giving great opportunities for discounted purchase on single family mortgages. They still had thousands and thousands and tens of thousands of these on their books. So we found that as a good opportunity, and taking the long-term perspective, we saw that the US obviously has the 30-year mortgage, which when compared to the rest of the world is an absolute gem. So combining new economic models of acquisition, combining the fact that we wanted to adjust our market strategy quite a bit and lean towards long-term payments, 10+ year time horizons, we found that the single family home market had the brightest horizon that we saw, and it had the most unique payment structure for fixed income, the 30-year mortgage, fixed 30-year mortgage. So we went all in on that and immediately got to putting that together and buying loans and building our own portfolio, and then opened it up to investors. So that was the big shift from those amazing relationships. Again, I stand on the shoulders of giants, people that taught me huge, core concepts and business skills that were way ahead of, a young 20-something-year-old guy should have had access to. And then now we apply those same things just in a different space.
Got it. So the single family mortgages, are these primarily distressed mortgages or are these performing mortgages?
The vast majority are distressed to some degree. They're non-performing is what we call them.
Okay.
So in that vein, what that means is the borrower is either not paying at all, which is common actually, or they have a rolling balance. Maybe during COVID, they got furloughed for 6 months. They got, back to paying, but there's still that 6-month balance. What do you do with that? And we target those specifically because we get good discounts on those. And a huge portion of the time, the vast majority of the time, the discussion with the borrower, the homeowner, is really, hey, what's your goal here? Right? Because if we bought this from Chase or Wells Fargo or HUD or whoever we bought it from, one of the big boys, and they want to foreclose. We're trying to help you not go through that, but where do you want to go? And usually it's like, hey, if I could just get out of this hole with these 5 months of missed payments, I'd get them back on track and we'd be good to go. So working things out with the homeowner has been the goal on our side. And that's driven by the fact that, I'd like to say that I'm brilliant and I know everything and I have a crystal ball, but I don't have any of that. What I do know for certain is the underlying fundamentals of different aspects of real estate are very clear. We know that there's a 4 to 6 million home shortfall in single family homes in the United States to reach a supply demand balance, meaning the country needs 4 to 6 million homes just to break even on a balanced supply demand curve. What we also know is that home affordability is at an all-time high. It's extremely difficult to buy homes, mostly because the last handful of years we've seen roughly a 47% increase in home values across the country. So all that to be said, we have more equity than we've ever had. So us investing into single family mortgages, these people don't want to walk away from a massive amount of equity. They want to work with us. They're incentivized to work with us. And on our side, we're fine because we're negotiating a 30-year loan instrument where we have a lot of stability into the future. So that's a good place to be. We like that position.
No, I love everything you said there. I mean, the first of all, the 30-year mortgage is I mean, for Americans, it's just assumed that that's the standard. But it is in America, but it's not necessarily anywhere else. Um, let me ask you, when you're acquiring these mortgages, is it a pool of mortgages? Are you getting them one at a time? How are you in tell me a little bit about how that works.
Sure. So the post global financial crisis, we had foreclosure crises, we had, millions of loans in default, right? And so in the post global financial crisis world, we've tightened up lending standards quite a bit. So back in the day, you used to be able to just buy one or buy a few, and you could just kind of easily sink get your toes wet into the industry. Where it's at today is there's really nothing that makes sense in the market unless you're buying at scale. So, for instance, we're underwriting a deal right now for that's part of a 750 million trade with a government agency. Now, we would not buy anywhere near the majority of that, just to be clear, but we would take a carve of that. We would take a position on that. And so you're looking at these massive trades. We are targeting around partnering on around 100 million this year. And that really, those, when you're dealing with those levels, the air is much thinner, but also the returns and the quality are much better.
So on 100 million, is that the value of the notes, or is that the what your investment will be?
That's roughly the value of the notes.
Okay.
So that's what we're targeting as asset value.
Okay. And as far as the discount, you mentioned earlier, up to 50% discount. Are you seeing significant discounts? I mean, like, is it 50 or 30%? What kind of a discount
We
are you?
typically target 25% of a value
25%?
discount. Yes.
Okay.
And so on that side, it's a sliding scale on certain things, but 25%, there's a lot of room there. We can pass some savings along to the homeowner. We can get a little bit more flexible with it if we're thinking a little bit long term on, 2, 3 years of an, exit and putting this thing together. Then we can either choose to get these reperforming, get the homeowner on track, get them stabilized with the loan modification, and then we can choose to sell those mortgages off or keep them in the portfolio for cash flow. That's where we really like to be. There's only a very minor thing, again, with the backdrop of the economy that I kind of gave, there's only a very minor percent that actually move through a foreclosure process because they would be nuts to walk away from that much equity, right?
All right.
So with our portfolio that's performing, we are typically seeing around 96 in the 96 to 97% range of on-time payments because they know they got a second chance, right? They don't want to screw that up on that side. So we like that model a lot right now.
No, that's, hey, if you've already got somebody that's willing to pay that just needs a little bit of help working out the details to continue to pay, and the numbers work, that's great. So on the 30-year payment schedule, is there a kind of a sweet spot that you find where, the maturity date in comparison to where you're at? I mean, is it like from 10 to 20 years left on the mortgage, or is it, um, or is there any thought process given to that? I'm assuming that
Sure.
at the end of the loan, it's not as attractive as it is at the front of the loan.
Sure. So there's a few factors. Usually these individuals qualified and they got a mortgage at X rate, right? And they had their better credit at that time because they haven't missed payments, right? And now they're on the back end. COVID happened, the world happened. We're usually looking at things in the last handful of years, 5 to 7 years, right? Is the vast majority of what we're looking at. And funny enough, during that period, while they might have had stumbling blocks, might have had issues in the craziness of the world during that period of time, also they took on more equity than ever. Their homes blew up in value. So it's a double-edged sword for them. They have a lot to lose. They also have a lot to gain. And then there's going to be some adjustment. So we typically, they don't have the same FICO score they did. Their rate is likely to go up. The rate is likely to go up because they're just not the same 720 score as when they applied for the first time. On that side, to your point of term left, we often adjust that. So we'll say, look, to keep your loan affordable, we can extend the amount of your term by X amount of years, right? And on their side, and then on our side, we're saying, and by the way, there's no prepayment penalty. So anytime you want to refi us out, go get a better rate. We are working with any bank that you put in front of us. We will help them. We'll give them the information. We'll try to get you qualified as much, from our side as possible. So refi us out anytime you want. We're rooting for you, but in the interim, you get to stay in your home. You have a set fixed payment, and you could ride this out or refi anytime you want if rates change over that period of time. So really on their side, it's about protecting equity. It's working with a lender. In this case, it'd be us as the lender that wants to help them get back on track and is willing to, work through the details with them rather than, a Chase or a HUD or any other whatever large agency or company that just would move through foreclosure. Their business model is to originate mortgages, for the big banks. Their business model is not to work out every mortgage that stops paying. So it gives us a, opportunity, and it gives the homeowners an opportunity. So that's what we like, is it's kind of, it's a more of a win-win conversation the majority of the time.
So I understand the acquisition. I mean, buying a mortgage.
Sure.
I understand kind of the borrower's predicament. I'm curious on the work through. Are you rewriting the loan? Is it a new loan? I mean, because you mentioned like the rate changes and you can extend the terms, or is that just an or an amendment to the current loan, or how's that work
We
out?
typically just do a full modification.
Full
Just
mod?
go through it, yeah, and just tighten things up along the way. Different considerations for different discussions. Kind of, the paperwork we need to have updated to what we use for our, kind of boilerplate standardized forms. And there are probably a lot of things that most people would see in most loan docs. But that said, we just freshen up from there. So it's a fresh start.
Got it. Got it. Well, I like the model from the standpoint of if you freshen up the loan and it's essentially a new loan, again, you're at the front end of the loan to where most of what they're paying is interest, as you as the note holder. And I'm assuming, when you do that, do you reappraise the property, or how do you go about setting your loan to value,
Value.
or is it just we're going to refi what you have plus what hasn't been paid, and here's the terms. Here's the terms. Is that am I
Yeah.
understanding
Oh,
that
yeah,
right?
yeah. Yeah,
Okay.
so top to bottom, and Darren, you're a risk guy. You understand insurance. You understand risk evaluation. So in the loan space and the mortgage space, and you already said this, by the way, but I'm going to highlight it a little bit again. One of the constant conversations is loan to value, period. Right? How cushioned are we as the lender from the market? How much of a margin is there for, different economic outcomes of different things that are unforeseen? We target a pretty low loan to value. We're targeting around that 50 to 55% LTV. And the reason for that is, again, the market's up 47% in the last handful of years for single family homes. So we don't need to be overly aggressive. One. And then two, on the flip side of that is that it gives us a huge cushion with borrowers that have a past of having, bumps in the road. Now, again, our on-time payment percentage is in the 96-ish% range. So we don't have a lot of missed payments once they're on track. But worst case scenario, we have to move to foreclosure. We're picking up, 40, 50% equity on that side. Not our target, not our preference, not our favorite exit, but we're very covered on that piece. And to nail down property values, we have a few different. We can get broker price opinions in many markets. We have software that overlays, recent appraisals in the area with, other versions of, digital appraisals. Times we will go through full title and full appraisal, depending on the deal. So it's really top to bottom. We feel really pretty comfortable. And then we also have an extremely conservative LTV. So it's double, triple, quadruple coverage is what we're looking for. Again, we're thinking 10 years. So we're not trying to squeeze out, a couple extra percent with a lot of extra risk.
Yeah. No, but I just the again being only 50% loan to value, while it gives you a lot of equity, it also gives you a lot of flexibility.
Absolutely.
If there is an exit and you want to exit sooner, you can take a little bit of a discount or whatever. And I'm sure there's a buyer that's willing to pick that up sooner. Um, I know that that whole foreclosure process it can drag out time wise and stuff. But I'm assuming you guys, if need be, you can incentivize the homeowner to get out sooner rather than extend it and make it a messy situation.
We see it all the time. It's called the deed in lieu of foreclosure. And,
Yeah,
it's times where they go, I have no interest in making any more payments. Just help me move out and I'm out of your way. And we go, okay. And then they send a deed in lieu of foreclosure. And so, yeah, we want things to be painless, the least painful as possible and to work together and be collaborative. So we're just trying to streamline whatever their best outcome is. We're here for it.
got it. So the funds you invest, are these family office funds? Are you raising funds? Do you have investors? How are you doing this?
Good question. So we focus entirely on retail investors today since about 2015. So we still have, a whole portfolio of commercial properties that we have with investors as well. But we're 100% focused today on the fixed income, the income fund, the Saint Income Fund. And that's hundreds of retail investors that we have on that fund. We work with, a handful of plus of new investors coming in every week. We're very, very focused on that retail crowd because I think it's a pretty good model that makes a lot of sense for sophisticated investors in the sense that it's an institutional model. The discussions we're having are Wall Street discussions. And so if we can bring that to the retail, space, retail investors haven't had as much access to this type of investment model. And so we have a unique niche. We can tell a unique story of what we're doing and how we're doing it. We have 2-hour webinars on different due diligence stuff that maybe only 10% of our investors find interesting, but it gives them a lot of confidence and it lets them go down the rabbit hole with us on it. So we really like the retail investor crowd, especially in the world where the stock market is, let's say 38% in 7 companies, 38% of market value in 7 companies. The stock market's lost 40% of the number of companies since 1995. So it's less diversified than ever on 2 different metrics. The Buffett metric puts it, so all those things, if you look at the alternative options that they have, bonds are at 4-ish%. Stock market has had some good years. It's very overweighted in many sectors and in many, aspects of that. And so I see a lot of investors looking around right now. And so we are a good fixed income option, and they really like the model because of that, because we're bringing an institutional level model to retail investors in a time where the market's just really dicey other places.
Got it. So it's a fund I mean, retail investors can invest in, accredited. I think I heard you say.
Exactly
Uh,
right.
is there a minimum investment?
We do 50,000. We want it very accessible for first time investors.
Okay. And as a fund, is this, I mean, I'm familiar more like the syndication where, you're in for the ride. With a fund, if somebody is looking to exit, how's that work?
Sure. So we don't do, an initial lock-in term. We consider it more of an initial term. So the initial term with us is anywhere from 6 months to 36 months. And then after that, there's no automatic renewal or anything. They're just in for as long as they want, and they can give a 90-day notice to have return of funds, return of capital at any time. So just getting them, their initial term under their belt, they can stay with us for as long as they want with 90-day notice on that side. So it's very flexible. There's no auto renewal or auto lock-in period that occurs at any time. It's just give us a head up after your initial term and we'll return capital in 90 days.
Got it. And do you pay monthly, quarterly? How frequently do you pay your investors?
So at the outset of the fund, we got the question of, well, how would I build this into my retirement plan? How would I build this into my lifestyle? So we've chosen, even though the accounting is, 3x more complicated, we do monthly distributions because we have so many people that rely on the income that they receive to pay their bills on a monthly basis, moving towards retirement, in retirement, So we do a monthly distribution for that reason. And I really like that model. I think that serves more people by quite a bit.
Yeah, I could see it being more attractive to a retail investor to have that regular frequency of the payment. That makes sense. So tell me, what are you seeing and what are your expectations? We've talked about, the 10-year hold. If an investor gets in, are they looking at a fixed rate of return? So like what the interest rate is, or is there any participation on the back end uh, well, I guess the back end would be if you sell the loan or you acquired the property. As a fund, if you're investing in loans, it's essentially the rate of return based on the borrowing rate. Is that pretty much the sum of it?
It's very stable on both sides. So what they
Okay.
receive is fixed and they get to
Okay.
choose. It goes
Okay.
anywhere from, 10 all the way up to 14.28%. So we're much higher return or we're much higher yield in the fixed income space. So on the flip side, on our side, we're targeting, 16 to 18 for our yield hurdle internally on the back end. And that's pretty much fixed. We're not seeing a huge variation month to month. Little stuff comes up, there's a foreclosure, we increase returns here, et cetera. But we keep them very stable, and that's what was requested by us. On the front, years ago, we used to do the syndication model as our bread and butter, and what we saw was just so wild. We'd pull 35 IRR on one deal and then 22 on the next, and really nobody should be upset at either one, but it's hard to, hit a bullseye on that. We know exactly what we are offering investors. So we know exactly what our hurdle is to pay out investors. We know exactly what we're targeting on what we're looking to invest on. And so that simplicity, it gives you the opportunity to think 10 years ahead. On a syndication, it's real hard to think 10 years ahead. I can't imagine anybody, especially in the era where it was very focused on value add and ground up development. God bless those guys. That's a tough space. And they, certainly have a lot of gumption for navigating a lot of the storms that they're in today. But for us, we want our investors to know exactly what they can expect, exactly what we're targeting on the front end and the back end. So we pay 10 to 14.28% returns on the fixed income side.
Yeah. And what would dictate the lower end versus the higher end? Is it the amount you invest? Is it the length of the investment? How's that determined?
Largely the length of the investment. So the
Okay.
investors get to choose really, they have two choices. What length? 6 months, 12 months, 36 months, totally up to them. Those are a sliding scale of returns. And then they can either get monthly distributions or compound. The compounding side means that it's just compounding year after year. And on our side, it lets us turn the money over with more deals. So they get a higher return for that consideration. So with
Gotcha.
two decisions, they get to choose where they fit best on both scales. So for IRA investors, they're probably going to choose the compounding side. They're going to get the higher return and they don't need the cash flow anyway. It's an IRA account, right? So that's a great choice for IRA guys. And for people that are looking for more cash flow to live off of, they're going to choose the monthly distribution side and understand that they get a slightly lower return, but they're getting the cash every single month. They get to live on that and enjoy that on a monthly basis. So, pros and cons, it's suited to what investors are looking for their lives.
Gotcha. And as far as your team, these the loans that you're purchasing, is there any, do you focus on a geography or is it nationwide or where are you going with that?
So our buy box is extremely focused, but less so geographically. It's more so about the property and the type of neighborhood. We like middle class. We want cookie cutter, middle of the road, 3 bedroom, 2 bath, white picket fence, family, nice, good area, middle class, cookie cutter. We don't go overly urban. Those, you talked about appraisals. Good luck appraising, a plus condo right next to a downtown ghetto. It's like what does that appraisal look like, right? And then on the
Right.
flip side, we don't do rural. It's just kind of same concept. The appraisal, the turnover, the selling those properties, and many other things are just too volatile for us. So we're sticking to middle class neighborhoods. We're sticking to very cookie cutter, middle of the road property types like 3 bed, 2 bath. We're looking at homes that are medium, median range, that $500,000 ish home. We're looking at very, very middle of the road for everything. Because God forbid there is a foreclosure, those trade very quickly. God forbid there is a foreclosure in a worst case scenario, then on the reality is the comps are very, very easy to access. And we have a very good idea of what the value is in a million other reasons. So that's more so what we're looking at. We have density requirements and, different, geographies that we're looking for, like schools, et cetera. But that's really the bread and butter is middle of the road, middle income, middle class, cookie cutter is what we really like.
Yeah, I like it. Repeatable. It's you have your parameters and you can match that up to the opportunity and allows you to provide some predictability for your investors.
And,
I'm
and
curious.
give the middle class a second shot, right?
Oh,
They
yeah, yeah,
need,
yeah. No, I
they're
mean,
getting
yeah,
their butts
absolutely.
kicked right now. So if we can
Yeah,
support them, that feels good too.
absolutely. I'm curious, what's in the time you've been doing this, do you have any kind of sense of how many are refining out um, as opposed to staying in, with a loan with you? Is there any kind of percentage on that or?
Great question. We commonly see roughly industry standards. So you see people refi every 5 to 7 years. They're doing a purchase or a refi. We see largely the same. We see in markets where rates are declining, we obviously see a higher degree of refis. We're fine with that. That actually boosts yields. And in markets where rates are increasing, we see less refis, which is fine with us. It gives us stability to the portfolio for a longer period of time. But here's what's interesting. If you dig into the Federal Reserve numbers, we look at the dot plot quite a bit, which for those that don't know, the Federal Reserve, the Federal Open Market Committee is a group of the Federal Reserve that puts dots literally on different time frames of what they can expect rates to do over time periods. So over the next year to two, we're seeing largely a retail mortgage rate of 6%. Might drop a quarter point a year. We're still in the mid fives. Those are really what we're seeing. So on the refinance scale for us, we see, according to the Federal Reserve, if they know what they're doing, not a whole lot of disruption for the next 1 to 2 years on that side for rates. So, and that's what Morgan Stanley says. That's what Goldman Sachs says. They all have the same expectations for the next 1 to 2 years. So if that's the case, what we already see is around industry standards, 5 to 7 years on our side. And what we expect is that to largely remain unchanged with what the Federal Reserve and with what the big investment banks and big financial institutions are, expecting. So that's not just today's outlook. I gave you that, but also a year or two into the future, we don't see a huge extra wave of refis or a huge rate hike on the horizon.
No, some stability is well needed. And I say well needed. I have also come to recognize that a lot of the opportunity is in the chaos. But I think for the average investor or home buyer or whatever, some sort of a stabilizing, what you can count on is kind of a good thing. It allows people to kind of go forward with some sort of a sense of, predictability. Makes sense. Um, Hey, Nick, if we could, I'd like to shift gears here for a second.
Sure.
As I've mentioned by day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. If we can't avoid the risk, we look to see if we can minimize the risk. If we cannot avoid nor minimize, we look to see if we can transfer the risk. That's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be, the feds, could be, demand, could be municipalities or, local governments, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Nick Deangelo, what is the biggest risk?
The biggest risk, I'll give you the biggest front side and the biggest back side. Biggest front side is always going to be due diligence. On our side, we have beaten that to death. We have overlaid many economic factors. Our due diligence confidence is at an all-time high. But what I see in the marketplace is many people not doing the due diligence to a real, true conservative estimate of outcomes. that is the biggest risk. And we saw that the last few years. And we see the back end of what that looks like, the optimistic, the rosy projections, things like that. And that's consistently what we see. And then on the back end, let's talk portfolio strategy. We have over 600 mortgages. We got, 19 syndications that we've done. The number one risk that I've seen on that side is not thinking long term. I know I beat that to death, but in the same vein of the underwriting and being over rosy with your projections and not really looking at the real numbers and the real economic data, on the back end of a portfolio, if you're not thinking long term and you're not thinking how these pieces come together and you're not thinking about how the management performs consistently over a long period of time, then you see shortcuts evolve. You see bad systems evolve. You see all kinds of shorter term thinking that lead to much bigger snowballed problems later on. So if people are heavy on their due diligence on the front end and know exactly what they're trying to target and whether or not something is specifically in their buy box or not, and how to get that information effectively, that's one piece. And then on the back end, it's building everything for stress testing over a long period of time, thinking about a portfolio in that same vein. So if you're doing those two things, I think you're going to be very, very, very well hedged against stress and risk in the future.
Yeah, well said. It's always I'm always amazed at how the lessons from the last cycle are so quickly forgotten. And but if you come back to that kind of just a conservative kind of a stress test and make sure you're not planning for the most optimal outcome, you'll probably be all right. That's good. Hey, Nick, where can the listeners go if they'd like to learn more or connect with you?
Sure. The best thing that I can give away that's super high value for extremely low cost, we are launching a book, Darren. And that book is called Economics Over Politics. And we are taking many of the biggest topics that are affecting our country today. We are tackling them from an economics perspective. So a really, really, really stripped bare finding the core issue. So if people want to check out the book that we're releasing called Economics Over Politics, they can check that out at saintinvestment.com/book. We're super excited for it. And we have a release date coming up very soon. So I'm excited to announce that as well.
Awesome. Well, Nick Deangelo, I can't say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Darren, I had a blast. Always good to connect with you, my friend. And I'll see you again soon. We'll have some fun.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.